And what we mean by this is there is an actual pattern of accumulation and distribution. These patterns of accumulation and distribution can take long periods of time. And so one of the principles we must ever keep in our mind, that we must assume that the trend can last forever. We can use measured moves and typical time durations. We can use planetary cycles or any other measurements, but these only give us estimates of trend exhaustion. But it's only a reversal of the pattern that's going to reverse the trend. And the greatest mistake traders make all the time is guessing when the trend is going to reverse and not waiting for the pattern to reveal itself. So the first thing you have to learn when you trade is when you make a trade, assume that that particular trade will last forever. This allows you also to stay with the trend and let your profits run, and then you can cut your losses very quickly when it doesn't work. But to just jump in and jump out because you're afraid of the market or you think it's going to reverse and there's no sign of the pattern reversing, this is a major mistake. Also, a corollary of this is there can only be one final high in a bull market or one final low to a bear market. In a strong uptrending market, if you try and short a top every single day or buy a bottom every single day in a bear market, is the road to ruin. As a matter of fact, most mutual funds use a strategy of looking in the paper for stocks making new all-time highs. And they buy those stocks. They always buy a new high because there can only be one final high. And yet in the bull market, you can have 100, 200, 300 days of new highs every couple days. Other strategies consist of finding a stock that hit a new high for the year and waiting for a 1, 2, or 3 day pullback, or a pullback of 1% or 3%, and then buying it, because the trend will bail you out and it will go to a new high if the trend is up. The other most basic principle is you must break 50% of a recent swing at a minimum to even think a trend is reversing. It's one thing to see a pattern reverse from higher highs and higher lows to lower highs and lower lows. But often, unless you can break back over 50% of the previous day or the previous week or the previous month, those longer-term trends are just having minor pullbacks, and they are not really reversing the trend. In the big picture, in a bull market and a bear market, they really consist of accumulation and distribution patterns. It is the big mutual funds and pension funds that create the bull markets. And basically, there is an accumulation phase at the end of a bear market when everything is at low levels. There's a tug-of-war between the people selling and the people buying. The buyers are very cautious. They're very price conscious. They don't want to pay too much, so they bid with limit orders. And the sellers have limit orders too to sell. After all that selling is done, there is a period where you have the run, where the prices go up. This is where there's more buying than selling, and this is the area where you want to trade. You do not want to trade in the basing area where you can just get chopped up every day and you can waste your time. You want to focus on breakaway runs where there is momentum, there is an angle you can use, and the stock or commodity is moving quite rapidly. Likewise, when you get to a top, you do not expect the top just to be a solitary affair and have the market immediately go right back down again. It takes time for distribution. Sometimes it's distribution, they break away and there's another run down to the bottom. Sometimes there's a little distribution and a false breakout and then another big leg up. But the idea is to define where these bases and top patterns are and trade as they break away from them. That's where all the money is made on these runs in between these. Many times these accumulation distribution patterns are not easily seen on various time frames, but there almost always will be there. So we can see them, and here was the case in 2008. There was the big drop in the stock market, and there was distribution and a runaway move on the downside, and then there was an attempt to make a bottom with a little accumulation in here, a little bit of a base, and advanced, and distribution again, breakaway to the downside, more accumulation. But if you look at this too, you'll see there's a little fractal where there's a little hook here, a little top and down. Here it goes up, the little top and down. And this whole section can be considered a bit of an accumulation pattern. And then you have the breakaway run. You get to the top, they don't immediately fail, but they go back and forth in the consolidation. And at this point, they either break away to the downside or it becomes a consolidation, and regaining this area here, they could start another leg up at that point. We see that one corollary of this accumulation distribution pattern is the well-known technical saying that the length of the base is equal to the height of the move. So in other words, if you measure that horizontal time distance of the base or the top, then that will be the distance in vertical price direction you get when you get a breakaway move. So you want to wait for these bases or tops to complete before buying. And you want to pick stocks that have decent bases to support a big run. These bases can be found on all time frames, 1 minute, 5 minute, 60 minute, daily, weekly, monthly, etc. So here's a typical example. Here was a little top, and this was on a 5-minute chart of Dell. After the top was complete, they had a little false breakout, but a big bar down, showing an impulse to the downside. And then a rough estimate of how far it would go down would be the length of this top, and this would be the vertical drop, and it would go into here. Then we have another pattern. Now this could have been a base for an up move, but in this case it turned out to be another top, and another estimated drop would be this length. But also in the bigger scheme of things, this is one big giant top. There was a big seller, little decline, more of the seller. So you could look at this whole big base as the whole distance of the drop. Then we have another basing pattern in here, and then we have an advance equal to about the size of the base. So as a general rule, you want to look at these base levels. You do not want to trade in here, because notice you'll get very chopped up. They go up and down and up and down and over in here in the top. When you're in this distribution, you want to define the limits of it, and you want to be in the move that breaks away out of that distribution or accumulation pattern, and that's where you basically want to trade. We see these accumulation patterns on everything, and we also see the general trend. The general trend is usually defined as stair steps. Remember, the trend is a pattern of lower lows and lower highs in a downtrend. And in an uptrend, we have higher highs and higher bottoms and higher highs and higher bottoms, and this is an uptrend. But we see here on the way down, lower lows, they rally, lower lows, they rally. They can rally back one, but not two. So this was the previous bar. This was the second bar back. Got a little bit higher, didn't make it to the third bar. Then they plunged here. They rallied back to the second bar, ran out of gas. Then they came down again. You went up 3, 4, 5 days and still couldn't regain the previous stair step. You went down. There was a bit of a base forming here, and then you broke away to the downside. This too, by the way, would be a classic buy signal. When you see a base forming, you have the breakdown and then it's regained. As soon as you find that you've regained the prior base, this whole area becomes a false breakdown. And then it's usually a good buy signal as soon as we get back to the level of the previous base. The other thing to note here is this area here with this steep angle with higher bottoms is something we have never seen before in the entire decline. You want to note the characteristics of the chart you're dealing with. Here, the big impulse bars are all on the downside. Big bars, and occasionally you'll get a short squeeze rally that will only last 1 to 2 bars, and then it will run out of gas and go down again. But the biggest rally we ever saw was over here, 5 or 6 bars up, but it didn't regain 2 to 3 stair steps back. Here we had kind of a choppy uptrending period, but each high was barely at the same level and didn't regain the last breakdown point over here. This is something completely different. This is a series where day after day after day after day we had higher bottoms on all the bars and higher tops, and it didn't respect any of the resistance levels. Here was the last breakdown point, here was another breakdown point, here's another breakdown point, and they're pulling back just a tiny bit. So once you see this pattern, the pattern is now a bull trend, and a bull trend can last forever. So don't be confused about this is going to be the top and it's going to run out of gas when it hits it. This is now a pattern, and it is a bull pattern, and it can go a long ways. We can also see after the accumulation period is done, there is this runaway where there's also continued accumulation. A lot of big institutions, after they get their foot wet, they want to keep adding and marking up their positions. And a steep move like this with a very steep angle has a couple days down, makes a little bottom, then it goes over here and has 6 or 7 days down to a much higher level. Then you have a big run again, 6 or 7 days down, much higher level, higher level, higher level. So we can see the stair-step pattern where every single pullback is at a higher level. Eventually, after you go many months of that, if you have a strong enough momentum move, you'll go into a 1, 2, 3, 4, 5 wave pattern that's a sideways movement. This is almost always a consolidation rather than a top. And then you break out again and go up even further. So the general trend here is clearly up. It's going up along a steep momentum move. We have higher bottoms all the time. Each of the corrections are about the same magnitude, and none of the corrections break a previous stair step. So that's clearly there are also bullish trends that are very volatile. If we note here, we go up with the big bars, we can see that there's gaps. They go up and then they plunge back down. They zoom up again, they plunge back down. But each of the little plunges results in a higher bottom. And then we have a big run up and a bigger correction down. And then we have a big run up and a bigger correction down. But the big corrections down also result in higher bottoms. So this is within a strong uptrend. And this is what also gets most traders in trouble. They usually see a gap in the market, like over in here, and by the time they see it on television or somebody recommends it, they jump in and they buy it right here at the high of the day. And then it goes 3, 4, 5 days all the way back down, and they lose money, and after 3 or 4 days, they give up because it's right back where it started from. No sooner than they sell out, then it gaps up again. And they're a little wary of it, so they give it a day or two, and it goes up, and they buy it again. Maybe they have a profit for 1 day, and then you go 7 or 8 days right back down to a loss, and they get out again. No sooner they get out, then you have a big gap. So note that most of the advances here are 2 or 3 day movements, and then there's often 4, 5, 6 day declines, almost back to where it started from, but never quite. So it's always a higher bottom. This is where your strategy comes in. When you identify a steep angular up move that's very choppy, you want to have a strategy to buy the dips after so many days down. And many of these days down, note, are only 50% corrections. From this low up to this high, it pulls back to about the midpoint. Then from this low to this top, pulls back to about the midpoint. Then from this big run up to this high, pulls back to the midpoint, maybe a little bit lower. And so these are the characteristics of these types of markets. Note, too, that every time you have a run to a higher high, it's much higher than the preceding high. However, when we get up in here, we've had a big run, and we're barely above the preceding top. Actually, only had 1 or 2 bars up, and it's back down. This may be a sign that this is really a double top, and this correction here may turn into another big correction, testing this level, and maybe even for the first time breaking down because you've had a full year of a big run. So we'll get into time limit durations and things to identify where some of these tops may exhaust themselves. But you want to watch for loss of momentum. Each top that is exceeded should be exceeded by the same amount it has in the past. In the bear trend, though, it's pure and simple liquidation. Here we have somebody selling. He can't get out. More people join him. They have to push it down. It rallies up to the previous low. Breaks down, rallies up to the previous high, previous low. Then you have a pure liquidating trend, goes to an extreme. Many of the sellers here decide not to sell, but to leave limit orders in permanently. It rallies back, hits their limit order, then they lower their limit prices, goes down, then it rallies up again, but the limit guy is still there. And so these are the lower lows and the lower highs of the bear market. And then occasionally you'll get a vicious short squeeze where maybe a big seller was around and the street knew about him, and it zooms up when he's done. But then again, all these lows over here become resistance. There's a rule that says future